Hi all, my name is Lauren Parmenter, a consultant here at Lysis Financial. Thank you for joining us today for the next webinar in our AML and KYC Leaders series. Today we have Amanda Parmenter from Lloyds Banking Group giving a webinar on adapting financial crime frameworks during the current COVID crisis. A small disclaimer before we start. As some of you may have noticed, Amanda is my mum, so this afternoon session is going to be extremely insightful for you and me alike. Before we begin, I will provide a short profile of Amanda's career so far. Whilst the webinar is being presented, please feel free to submit questions through the Q&A section of Zoom, which you should find at the bottom of your display, just a Q&A bubble. At the end of the session, we will then go through the questions asked. Please feel free to submit these questions at any time throughout the session. So without further ado, Amanda has worked for Lloyds Banking Group for 34 years in a variety of roles across the group, including branch banking, group internal audit, credit risk, operational risk, and for the last 15 years has focused on fraud and financial crime prevention. She is currently the head of fraud and financial crime policy, responsible for setting the group's site of fraud and financial crime policies and the group's risk appetite. She was responsible for leading the group's response to and building the control framework for the corporate criminal offence failure to prevent the facilitation of tax evasion. And prior to that, was a risk partner on the group's FATCA programme. She is a member of the UK Finance Financial Crime Committee and is working with private sector peers and the public sector to support the delivery of the UK Home Office's Economic Crime Reform Programme, including the reform of the SARS regime. So without further ado, I will hand over to Amanda.
Thanks very much for the introduction, Lauren. Can you hear me okay?
Yes, can hear you fine.
Lovely, thank you. So my thanks to Lysis for the opportunity to share some of my thoughts with you all today. I've prepared some slides and I'll spend the next 15 or 20 minutes walking through those, and I think they might be available afterwards via social networking. I think Lauren and her colleagues are going to organise that. I think we've got about an hour or so today. I don't intend speaking for all of that, and I hope that we have plenty of questions coming throughout the presentation, and we can enter into some debate and discussion on some of those topics and questions a little bit later. So, okay. Right, okay, so I thought it might be interesting today to think a little bit about the impact of COVID-19 and to explore how we might go about adapting our control framework to reflect some of those impacts. So if we go back to March, only a few months ago, but does seem like a long time ago, the country entered lockdown and almost all of us, without exception, went into isolation. Travel all but ceased. There was a vast increase in home working. Many thousands of people across the country were furloughed, and unfortunately many people have been impacted by unemployment. Alongside that, all education ceased, so schools, colleges and universities closed, and all of the service sector ground to a halt, so the shops, restaurants, cafes, etc. And that brought about quite a bit of panic buying, and I think brought about the primal urge in many of us to go and hoard toilet paper and dried pasta for some strange reason. Meanwhile, the infection spread, our health service and capacity has become increasingly stretched, and sadly many people have lost their lives to the virus. Sorry, I'm just struggling with the delay on the slides moving forward. Bear with me. Okay, so what did that mean for the financial services sector? Well, for customers, it saw quite a marked change in behaviour. quite obviously, there's been far less demand for physical branches, and conversely, an increased demand on digital channels. So many more people have wanted to register for online banking, and that's put quite a strain on telephony services and centres. And for many people, their financial circumstances have changed, and their financial needs have changed as well too. Many wanting to take up the opportunity to have loan and mortgage repayment holidays. And as a consequence of all of that, their transactional behaviour has changed as well. It may be obvious, but there's been far less need for cash, and spending habits and the way people spend has changed. It goes without saying that there's been huge colleague impact as well. So not only have some of the above impacts impacted all of us too, but we've all got competing priorities at home now. You know, some of us are homeschooling, some of us are having family members and friends to care for, all at the same time trying to work from home. Some of us have been able to work from home, some of us haven't, and the ability to get to work and using public transport has been challenging for many. And I think I mentioned earlier, therefore the ability to resource some telephony and operational teams has been quite challenging. And to go with that, we need to think about things like systems capacities, far more strain on our systems, and so therefore there is far more reliance on system resilience. And we've had to think very differently how agile our systems are adapting at a much quicker pace. And I don't know about your organisations, but certainly Lloyds Banking Group, traditionally it can seem like forever to make a decision, let alone implement change. So that's been quite a culture shock for us, I think it's probably fair to say. So in terms of our, or your fraud and financial crime control framework, and against that backdrop, what does that really mean? What's the so what? And in terms of issues, it's really meant that there's far less people to maintain our control framework. Customers are less able to open accounts in branches, and that's driven them far more down the digital route, which is great actually, because the experience is good for customers and it's good for us. But for those occasions where that electronic route doesn't quite work and they might have failed some of our checks and balances online, ordinarily we would have directed them to the local branch to take in any appropriate paperwork or ID verification, and of course they're not able to do that. And they're less able to provide, particularly in the corporate and commercial space, any certified documentary evidence that we might require to complete our customer due diligence or our ongoing due diligence activities. And then in terms of servicing our customer needs and completing our ongoing due diligence, we've had far less access to our customers generally, as they quite clearly have other priorities too. Along the way, for us, certainly there's been some curveballs, and for many other financial institutions there will have been as well. And particularly things like some of the government support programmes spring to mind. So the CBILS and the grants and the bounce back loans has created a mountain of work. And at a time when resource is stretched, it's been very challenging. And whilst I won't talk about what Lloyds has done specifically, I can remember when the government announced its bounce back loans, on the very first day that people were able to apply for those, we had something in the region of 26,000 applications on the first day. And with a government steer that there's an expectation that funds are released within 24 hours, that put an awful lot of pressure on, certainly us operationally. So many colleagues were redirected to go and support that kind of activity. And all of that means that we have fewer and fewer people stretched across to manage our financial crime control framework, and far less people available to kind of monitor and oversight that activity. But all the while, we've still needed to service our customers because they've still had banking needs. We've still had to manage our risk, that doesn't go away. And all the while, the criminals are still working very hard, and COVID-19 has just presented them with yet another opportunity to exploit, the very many vulnerable individuals and companies out there. So for me, we kind of ask, I've asked, where's the flex in our control environment? And before I think about where the flex is, I kind of went back to first principles really, and went back to basics and thought about, well, what does our control environment look like in a BAU environment? And I thought if I could kind of plot it out in a pictorial way, it would look something like this. And I'd categorise our control framework in probably three key categories. And if I start at the bottom of this slide, we've got the kind of group of legislation and regulation that we all have to comply with. I've not listed them all, but there's just some examples there. That's the what we should do and what we must do, and there can be no deviation from that. If I look at that second band across the middle, that's kind of the industry guidance, and there's lots and lots of it out there, but the obvious ones are JMLSG, BATF principles, Wolfsburg principles, and the FCA's guide for firms, which is quite insightful. And, excuse me, and then above the line, we've kind of got what I call internal policy and risk appetite. In a BAU environment, I think, you know, most firms will make sure that their policies and procedures cover off that bottom band and that middle band. But for me, that upper band, that green section, is really where we can flex our risk-based approach relative to the types of customers that we have, the types of products that we sell, and the jurisdictions that we operate in. So I think in a BAU environment, that green band is where our flex traditionally is. And there's nothing groundbreaking about that. It's, you know, it's kind of fairly standard, but for me, it served as a you know, quite a useful reminder in terms of where was my wriggle room really. So where is the flex? Now, I've kind of used the same principle as on the slide before, and for me, the absolutely non-negotiable zone is that red zone at the bottom, and probably a fair amount of the industry guidance, because I think it would be unwise to deviate from that too much. But for me, that flexibility zone is probably stretched a little bit, because some of the industry guidance is just that. It's reflective of best practice. But I think many of you will agree that some of that industry guidance is a little outdated today and hasn't necessarily kept up with the pace of change, particularly some of the technological developments that have come along over the last 3 or 4 years. And so for me, that's key. And when I break it down, fraud and financial crime, into its component parts, kind of our thinking was, you know, in terms of sanctions and making sure that we're not doing business with anybody who's subject to sanctions, our appetite didn't really change, and we didn't believe that we had very much flex there. We certainly didn't want to ease any of our controls. So we've pretty much left that control environment as it is. And the same for anti-bribery, actually. We didn't feel that it was necessary to make any changes. And actually, the impact of COVID-19 didn't have much impact on the effectiveness or the operation of our anti-bribery control framework. So we decided to leave that pretty much alone as well. Now, I've put fraud on there, but I've greyed it out because I think fraud is quite different in terms of appetite, because, you know, many firms will almost monetize their appetite, and the fraud appetite is really down to how much money do you want to lose as a firm to fraud, balanced against the customer experience. Because I think many firms will recognise that you could significantly reduce your fraud experience if you up your controls, but upping controls in the fraud space means that customers have a far or experience far more friction when they're shopping, you know, be it face-to-face, online, and they don't want that. So it's kind of determining where that balance is, and I think that's very much, you know, a firm-by-firm decision on what they want to do there. And for me, our biggest opportunity to adapt our control framework was certainly in relation to our anti-money laundering controls. So that was our kind of our space for kind of playing around with that, if you like. Oops, oh Lauren, I've gone one slide too many, thank you. I think along the way, what has been really, really helpful for us is some guidance and some publications that have come out from the Financial Conduct Authority. Now, they published several statements supporting the adaptation of your control framework. And for us, that was quite fortuitous because we'd forerun some of the guidance that they'd given. So when they published it, we actually breathed a sigh of relief because we were thankful that our approach was aligning quite nicely with what they had to say. And if you do get a copy of the slides later, the text highlighted in blue is a link, it will take you to that. But they were supportive of and acknowledging the challenges that COVID-19 was bringing, particularly in the customer due diligence and transaction monitoring space, in terms of customer availability, ability to complete some of the documentation, and the ability to keep up with managing and assessing your transaction monitoring alerts. And I actually attended a discussion with the supervisory team at the FCA probably a couple of months ago now. We had the opportunity to chat to them about some of the guidance and some of their expectations, and they supplemented their written guidance with some really helpful commentary actually. So things around, in particular, transaction monitoring. It's very tempting not to do anything with your existing controls and let your rules run as normal. But if you have less people available to manage and assess those alerts and determine whether you want to disclose on them, then what's going to happen is you're going to get a backlog. And the FCA felt very firmly that they would prefer firms to consider the effectiveness of their transaction monitoring rules and make a risk-based decision to temporarily switch off some of those rules, rather than allowing their existing rules to run and create a backlog because there won't be people to work them. In their minds, they felt that if you created a backlog, then what you were doing is saying that you had a commitment to work that and remediate that backlog at a future state. And I thought that was quite a helpful steer. So in terms of what's up for grabs, in terms of the AML control framework, still not quite got the hang of these slides. These are some of the things that we've certainly considered. So ID&V, verification documentation. I've already mentioned that, you know, customers, be individuals or commercial customers, have not been able to come into branches with documentation to be able to verify the CDD information that they've been giving us. And so we've had to think about what's a reasonable alternative. We still want to have sight of that documentation, but what does that look like? Are there any conditions where we would ever be happy to accept customer selfies or customers' photos of those documentations, or homemade kind of photocopies of those documents? Ongoing due diligence. You know, many firms have implemented a cyclical review program, say 1, 2, 3 years, dependent upon the risk rating of the portfolio or the customer or the client. And so is there any wriggle room in that kind of cyclical review program, that such that you feel that some of them you could move on 6 months or a year where they present the lowest degree of risk? Going back to the transaction monitoring, you know, we've thought about, should we change our rules? Should we keep them all on? Should we work all of the alerts? And in particular, we thought a lot about the rules that are related to cash transactions, given that we saw very, very quickly the amount of cash moving around fall exponentially. We thought well, perhaps we can switch off our cash transaction monitoring rules. But then there's part of you that thinks, actually, there will still be part of the criminal community that will want to launder cash. And what they might do is use businesses as a front to continue to do that. So we thought about, keeping rules or adapting rules to look for businesses that we would have expected to have closed, so say restaurants, where we were still seeing cash deposits, because that might be a red flag that we were interested in having a look at. In terms of sanctions and PEP screening, again, very aligned to the transaction monitoring. Do we keep all of that running as normal? Do we adapt our rules? Do we suspend some of that? And I think I'd already said that, sanctions, we didn't have any appetite to loosen our control framework whatsoever. And because we use the same screening technology for PEPs, we felt actually we would keep that going as well. But I think all of those are up for grabs, particularly in the PEP space. And again, exactly the same principles for adverse media screening. And when we decided on our approach for all of those three things there, transaction monitoring, sanctions and PEP screening and adverse media screening, we were very mindful of the SCA's comments on adapting rules or working a backlog as a remediation. Customer exits. We'll all have customers from time to time that become outside of appetite from a financial crime or fraud perspective. And ordinarily, you know, we'd be issuing them with notice to close and closing the accounts down. And that was still the case. And with my risk hat on, I would still absolutely want to do that. But we've also had to think more widely, particularly around the conduct perspective, because if we were to exit a customer, then the chances of them being able to go and open a bank account elsewhere during lockdown was highly unlikely. So what controls could we put in place as an alternative to make sure that we were being fair to them, to allow them access to the banking system, but also mitigate the risk that we felt that they posed? On fraud controls, again, do we tighten them, do we flex them, do we switch them off? And that's interesting, because if I go right back to the very first one here, ID and V verification, and customer selfies and photos of documents, that's great from a customer experience perspective, but it actually opens the door a little bit more for fraudsters. So it's been really interesting kind of monitoring that kind of activity to see if there's been an uptick in fraud for those accounts where we might have allowed them to provide their documentation through their own photographs or through their own photocopies. Bribery, supplier due diligence and gifts, entertainment and hospitality. We were less concerned about gifts, entertainment and hospitality because of course a lot of that has fallen by the wayside, so we left that control framework alone. And again, supplier due diligence, I think for those individuals who seek to use the sourcing process as a mechanism for committing crime, we thought COVID-19 would give them just another reason to do that. So our view was we would keep that the same. Shared service providers, many firms use those, either internal service providers or external service providers. And so, you know, we were very mindful of both internal and external providers. You know, were they adapting their operations in a way that still sat comfortably with our risk appetite? And so, you know, you might enter into some very interesting discussions there. And I'm sure there are lots and lots of other things to consider, but I think they were the key ones for us, certainly. And then you kind of come on to the practical, robust risk management aspects, governance. Who needs to know about what you've done and when? You know, make sure that your senior management are supportive, and make sure that they're provided with enough information to be able to make a risk-based decision if the control framework's being enhanced. And for those firms who kind of use the traditional 3 lines of defence model, you know, this is the business, the first line of defence, making decisions about the risks that they own. But I would certainly encourage any first line business to engage with their second line risk functions, just to get that comfort and challenge, and make sure that however they want to adapt their controls, it kind of sits comfortably. And then finally, monitoring and oversight. I think it's really, really important, particularly at times like this, that we adapt our monitoring and oversight routines to the situation that we're trying to manage. So it might mean suspending on a temporary basis any second line oversight programs, or indeed third line audit activity, but adapting that to the activity that you're undertaking at hand. And you know, we've kind of continued to look back on some of these things and tweak some of the controls along the way, but we're kind of 12 weeks later now, and the world's kind of changing again. You know, the economies of many countries is on their knees, and whilst the infection rate generally around the world is reducing, although I know in recent days it's going the other way again, there is an absolute need to get the country up and running again. And we need to start thinking about what that transition looks like going back to BAU, and when and how we might do that. But in thinking about that, there are still so many unknown variables. I mean, we've got government rules and advice. It changes and it's updated every week. And while that's great on a personal level, and you hope that every Sunday you're going to be allowed a little bit more freedom and to be able to do more things, what that means is, as a financial institution, you've got to be increasingly agile and be able to respond to that and think about how that might impact your control framework. And a further challenge on that, even in the UK, the various different component parts all have different rules. So it's challenging enough if you just operate in the UK, because what you're allowed to do in England is different to what you're allowed to do in Scotland, which is different again to what you're allowed to do in Wales, and so on. And if you have a more global footprint, that becomes even more challenging. And if we think about consumer behaviour, this is just a picture I picked up from the press the other day when some of the shops started opening in central London. You know, there's a mass exodus to get out and to you know, to go and do normal things. And so what that will mean is spending and transactional behaviour changes. So we need to be sufficiently agile to be able to respond to that and tweak our transaction monitoring systems accordingly. And then you've got kind of workforce returning to the workplace. You know, as the country starts to get back to normal, I think firms, certainly larger firms, are starting to think about actually what does new world of workplace look like for us. Many firms have been able to successfully implement home working for many of their colleagues at quite a pace, and are realising actually that working from home can be equally effective. There's lots of really good technology out there to be able to stay in touch and to speak to one another and conduct meetings and collaborate. So I think this traditional notion of commuting and going to an office is going to change, but nevertheless the availability of your workforce to work effectively is still going to be quite important. So where are we? Well, we're at the stage of kind of preparing for transition and thinking about what that might look like. And you know, I think we're all working in a cost down environment, and that means it's quite tempting to maintain some of these new ways of working, but I think it's really important that we take a moment to pause and look back over what the last 12 or so weeks have meant for us and for our control framework. And so, to the point that I made earlier around ongoing monitoring and oversight, I'm going to be really keen to see, well, what has that shown us? Has it highlighted any areas of risk that we hadn't anticipated at the beginning of lockdown? Or has it confirmed to us that we can adapt our control framework and keep some of those things in place when we transition back to BAU? If we've changed our approach to ID&V and customer due diligence, I was talking about those custom selfies and photographs and things, have there been any unintended consequences of that? So I'm again going to be keen to look at some results comparing those new accounts that we've allowed to be opened in that manner. Has there been a detriment from a fraud perspective? Has there been an increase in mule activity that we've seen as a consequence? And has there been an increase in mule activity, particularly for the receipt of some of those government initiatives like the bounce back loans and the local council grants and things? Transaction monitoring, having a look at that, and the results of that are going to be really interesting. So I think a thorough review of how you've adapted your transaction monitoring rules is going to be really important. And if you have a backlog of alerts to work, be it transaction monitoring from your screening, adverse media screen or sanction screen, it's going to be important to think about how you deal with that, because the regulator will expect you to have a plan. The next one's quite an interesting one, actually. Has it made you think more about managing risk rather than tick box compliance? There's a lot of talk about tick box compliance with the regulator, and certainly in industry body meetings like UK Finance. Sometimes I think it's overplayed, actually, because there are absolutely things that we need to do and we need to evidence that we're doing. And therefore that naturally drives a kind of tick box approach, but we do it all to manage fraud and financial crime risk. And one of the things I've been really pleased about actually is where we've encouraged the business and given them the bandwidth to think a little bit more laterally about their controls. And the way that they've done that is to think about risks. And this is where your threat assessment and your risk assessment comes to the fore, because if you understand what your threats are and what your risks are, then you're better able to adapt to that. Has it made you more agile and less bureaucratic in your decision making? Well, certainly for us it has, because we've had to be. You know, if we had deployed traditional decision making processes and governance, we'd still be thinking about it or talking about it today. We would never have done anything. So for us, that's been a big benefit. And it has accelerated us using more and more sort of kind of digital solutions and robotics and artificial intelligence and technology more. So there'll be lots of that we'll want to kind of review and see what we can maintain. And very important, I mean, I don't think we should forget about the fact that actually the customer is the heart of everything that we do, and we exist for the customer. So how has the customer experience changed in this time? And I think it would be really beneficial to get some feedback, particularly from those new customers who have used the benefit of some of those slightly adapted onboarding kind of techniques, if you like. And then kind of finally, what would I do? I think I've probably touched on some of this already. And going back to my earlier slide on what's my non-negotiable zone and where's my zone of flexibility, I'd review the effectiveness of what I've changed. And I'd think very carefully about how that's controlled my risk, and where and if I want to change my flexibility zone a little bit. And, you know, what do I want to keep? What do I want to revert back to? And what might I just want to adjust? But wherever we land in terms of conclusions, I think it's going to be really important that we have a roadmap and a plan of what we're going to do and why we're going to do it. And also think about any curveballs that might come along the way. I mean, it's fantastic that we're able to ease some of the lockdown requirements, but we're already starting to see a little bit further around the world to the east, the virus kind of rearing its head again. So I think we have to stand prepared for the fact that we might need to go back into lockdown again. So what does that actually mean for our control environment? We can't keep yo-yoing between the two. And again, how will I monitor that, and who needs to know, and how are we going to get that approved? And then the very last thing I'm just going to say at the end there, and I say this, it feels like I say this every day of my working life, is just document everything that you do. Write down what decision you've made and why you've made it and what information you have used to help you reach that decision, because that may well stand you in good stead one day when the supervisor comes along and wants to have a look at what you've done, because you can bet your life once we've come out the other side of this crisis, one of the things that the regulator is going to be interested in is how did you manage that? In exactly the same way that if an IT system goes down, you know, they're on top of you like a ton of bricks in terms of your IT resiliency, and they want to know that you've got controls in place to make sure that it doesn't happen again. I'm convinced that the regulator is going to be writing a Dear CEO letter at some point, either later on this year or early next year, to find out what we've done and what we're going to do in the future. So I'll stop there. I'm mindful of taking up a little bit more time than I said I would. So thank you very much for listening, and I'm going to hand back to Lauren, as there may be some questions.
There are indeed. Thank you very much for that. The first question that we have is, the person is interested to know how market volatility and changes in volumes have affected your transaction monitoring process.
Oh, it's changed it in several ways, actually. So we have seen, I think, as I alluded to earlier, a big decrease in cash transactions. But we have seen not quite a commensurate increase in kind of debit and credit card transactions, but a lot more online shopping in particular, because obviously people aren't going out to the shops. But overall, I think probably less transactions, which has meant that the volume of alerts coming out of our transaction monitoring systems has been less. So that's actually had a positive effect, because it means we've been able to redirect resource elsewhere, which is always a good thing. What I haven't seen yet is the results of the transaction monitoring rules that we've tweaked during this time. So that's going to be a really interesting thing to see. Hopefully that's answered that question, Lauren.
Yes, thank you. Next question. How do you feel about the widespread use by fintech and others of smartphone video ID and V? The Home Office have guidelines for use when establishing the right to work in the UK.
I have mixed feelings. So I think we should absolutely embrace technology, because if we don't, we'll get left behind. And I think key to technology being successful is understanding what it does do and understanding what it doesn't do, but also understanding what the unintended consequences of implementing that technology might be. So we already use biometrics and digital technology in some of our channels for onboarding new customers. But we've been very mindful when we've implemented that of some of the fraud risks, as well as kind of some of the financial crime and kind of AML risks along the way. Again, not seeing the results of any analysis yet in terms of how many customers have opened accounts using that kind of technology in the last 2 weeks versus our fraud or other financial crime experience. But all of those things will be taken into account. I mean, I'm generally supportive of technology as a general rule. I mean, why wouldn't you? But I think it's too early to say whether that's had an overall positive or negative impact.
Thank you. And the final question is, as you transition, what is Lloyds Bank's view on the percentage split of staff working from home or in the office?
Oh, interesting question. I mean, we, generally speaking, as an organisation, there's about 80,000 colleagues that work for Lloyds Banking Group, or there or thereabouts, predominantly in the UK, but there are some overseas. And I think if I remember back some of the statistics that I saw fairly early on, typically around about 2,000 of those colleagues were permanent home workers. And then a number of us with, you know, like many of you with laptops, you know, may work from home from time to time just to kind of, you know, get a bit of variety to your working week, if you like. In a 3-week period, I don't know how we did it. I think it's quite astonishing, but we managed to get a further 40,000 people working from home and issued with laptops. And within a month of lockdown, all of our call centre staff, all of our colleagues answering the phone for concerns around fraud, all of our transaction monitoring colleagues, all of our colleagues who deal with screening, be it payment screening, customer screening, were all working from home effectively with all the right access to software in a secure environment. And that's probably the biggest proof of concept Lloyds Banking Group has ever done in such a very short period of time. And it has proven very successfully that we can do that. And so I think that it will lead to quite a marked change in the way that we operate. I think, you know, I'm traditionally one who likes to be in the office. I like to be amongst people. And I think there is a lot to be gained from people working side by side. And I really get a lot out of the kind of conversations and debates that spark just by somebody asking a question or making a statement. And those times when everybody suddenly turns their chairs in and you're sitting in a circle having a good old debate over something. but it's how can you recreate that atmosphere in a virtual environment. So it's making us think much more creatively and use the technology much more than we've ever done. We've always, we've used WebEx and things for a long, long time, but many people are camera shy, so they always have a sticky plaster or something over their camera. And now, because you kind of miss people, you take that off. And so I think there will be a big change, and I will be really supportive of that. But it's about striking the right balance between making sure that people feel engaged, that they feel part of a team, that they are supported but empowered still where they need to be, and that you find ways to get together still. So I think it's kind of finding that blend, but it's also about confidence in people being able to use public transport if they have to commute to work, be that just a bus, a tube, or an hour or two on a train every day. And I think it'll take a little bit of time to get that back, but I think we're going to see profound change in the working environment. I think the City of London will look quite different in a year's time. That's my personal view, not necessarily Lloyd's view, but that's why.
Thank you. And I believe we have another question. I think we've got the time. Do you think this current challenge will mean more automation of the KYC processes in future?
Yes, is my very quick
yes.
answer to that question. I think it has to be. I mean, many firms have been exploring digital solutions for customer due diligence and ID&V, particularly the bits of that are just very repetitive and rote. But I think this has accelerated in many ways. So yes is the answer to that question.
Brilliant, thank you. So I believe that is all of our questions for today. Thank you so much for your time. For everyone listening to today's webinar, we will send out a link after the session has ended to the recording of this session, so that if you want to watch it back, you can. Thank you very much, Amanda, or Mum, for your time. And everyone keep safe, and we look forward to seeing you at the next webinar. Thank you so much.
Thanks, Lauren.